How employee provident fund, that is EPF, is taxed. That's a topic for discussion today in the Market Secrets investment series. Before we get into today's session, I'd like to mention that we at Market Secrets had recently launched Algo Traders Program ATP. If you are someone who is interested in learning end-to-end algo trading, then you can consider joining our ATP program. I'll leave the link to it in the description section of this video. And with that note, let's jump into today's session on how EPF returns are taxed. When we talk about EPF returns, we need to talk about three different stages and how taxation works in each of those stages. Number one, investment stage. Number two, accrual stage. Number three, maturity stage. So let's talk about it one by one, and let's start with first the investment stage. So when you take EPF, there are two components here. One is employer contribution and second one is employee contribution. Okay, so we need to talk about both these aspects on all these different stages. So let's start with investment stage, and for that let's start with employee contribution. So when an employee contribution was made under EPF, one could claim a deduction under section 80C of the Income Tax Act against employee's contribution up to 1.5 lakh rupees. So for employee contribution up to 1.5 lakhs under ATC is completely tax free. So this is for investment stage. So any investment that you make into EPF up to 1.5 lakh will be eligible for tax deduction under ATC of Income Tax Act. So this will obviously reduce your taxes during the investment stage. Likewise, employer contribution. Earlier, there were no ceiling, but effective April 2020, any employer's contribution to provident fund, that is employer's contribution to PF exceeding 7 lakh 50,000 rupees is taxable in the hands of employee under the head income from salary. Okay, so the limit here is 7.5 lakhs. Anything above that is taxable in the hands of employee. So for the investment stage, you can claim up to 1.5 lakh as employee contribution and up to 7.5 lakh as employer contribution. So this is something most of us would already be using. That is the investment stage. And now the accrual stage. So accrual stage is nothing but when the interest is declared on the accumulated balance. Okay, so that is nothing but your year-on-year interest payment in your PF account. So let's understand how that part is taxed. Okay, first of all, if there are any contributions that is beyond 7.5 lakhs, right, so, under employer contribution, then any returns from it, that is any interest payment or dividends that you earn from that such an excess contribution will be taxed as well in the hands of employee. Okay, so if your contribution from employer part of EPF is beyond 7.5 lakhs, any excess contribution and any returns from that particular contribution is taxable in your hands. So most of us won't fall into this particular bracket, so you don't have to worry about it for now. Okay, but for any contribution below the 7.5 lakhs, there's no income tax that you need to pay at the accrual stage. So all of that will be completely tax free. So you will have to worry only if the employer contribution crosses 7.5 lakh rupees per year. Most of us won't fit into that category, so you can ignore that for now. Now let's move into the employee contribution. Okay, so earlier there were no ceilings here, but effective April 1, 2022, any interest on the employee's contribution to the EPF up to 2.5 lakh per year is tax free, and any interest that earned on any contribution over and above 2.5 lakh. So if you want to contribute more than 2.5 lakh, you are allowed, but any returns from that particular amount will be taxable year on year. So this is very, very critical thing that you need to understand. So if you are in investment into EPF is beyond 2.5 lakhs in an year, then any returns from it will be taxable in your hands. So you need to clearly remember that, and you need to pay taxes while filing ATR. This threshold of 2.5 lakhs is actually increased to 5 lakh rupees in case the employer is not contributing towards EPF. So if employer is not contributing at all, right, in such cases this limit is actually enhanced to 5 lakh rupees. So again this comes into play during the accrual stage and taxed at your slab rate. EPFO will generally maintain EPFO balance of individuals in two separate accounts for taxation purposes. Earlier, there were two different classifications, one for employee contribution and another for employer contribution. Now, the employee contribution itself is split into two separate sections. One is to track any contribution within the limit of 2.5 lakh rupees, and the other one is to track any excess contribution and its interest payment. Okay, so under this employee contribution, now there are two separate accounts. So one is a tax-free account which tracks the first 2.5 lakhs that you put on every year, and the second one is a taxable account which will track the excess contribution. So EPF is also now getting really complicated. So it's better not to contribute beyond 2.5 lakhs from employee contribution. Okay, so this includes VPF as well. Okay, so that is what you need to remember. So this is what you need to understand at the accrual stage. So in simple terms, employer contribution and any returns from it up to 7.5 lakhs is completely tax free, and if it crosses 7.5 lakhs, in all such returns will be taxable. Likewise, when you take employee contribution, anything till 2.5 lakhs and any returns from it is completely tax free, and if it crosses 2.5 lakhs, right, any excess contributions and returns from it will be taxable in the hands of you, that is the employee. Okay, so this is the accrual stage. Okay, and now comes the maturity stage. Okay, so this is nothing but when the amount is withdrawn from the fund. Okay, so if you are manually withdrawing anything from your APF account, then that taxation that comes into play during that particular stage is called the maturity stage taxation. So no tax is required to be paid on the contribution amount and the accumulated interest in case the accumulated balance in the EPF is withdrawn after 5 years of continuous service. So if you are doing continuous service for 5 years and if you want to pull out some amount, right, so you don't need to pay any taxes for that particular amount. However, in case the accumulated balance is withdrawn prior to completion of 5 years of continuous service, then the balance and interest won't be fully exempt from tax. Okay, in such cases, taxation will come into play. The tax on such withdrawal actually falls into three different categories. Let's talk about it one by one. First one is employer contribution and interest. Okay, so any employer's contribution and interest on the same is fully taxable in the hands of employee under the head income from salary, and it will be taxed at your slab rate. So if you are withdrawing before 5 years, employer contribution part will be completely taxable and you need to pay the tax at the slab rate. And now, employees contribution. In case where the deduction and ATC is claimed, so we talked about this earlier. So while contributing towards UPF, you can claim some income tax deduction under ATC. So if you have claimed such deductions, right, the amount of employees contribution shall be taxable. Okay, so if you have claimed that exception and if you are withdrawing before 5 years, then it will become taxable. So during withdrawal phase, it will become taxable. Otherwise, it is tax free. So in first case, you need to pay taxes at your slab rate, and if you haven't claimed any ATC exemption, then you don't have to pay any taxes. Okay, so that's for employee contribution that you have contributed. Okay, but there is another component here, that is interest earned on the employee's contribution. Okay, so that is a separate part, and that part will be taxable in your hands. Okay, so that will fall under income from other sources, and that will be taxable in the hands of the employees. So this is a separate category. Okay, so I know this looks a bit complicated, but even with these complications, EPF still remains the most loved and sought after retirement planning scheme for majority of individual taxpayers. I hope this session was useful. If you have any queries, comments, or feedback about this episode, leave it down in the comment section. Also hit the like button if you have liked this video and share it with your friends if you find it useful. Also subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.